there's a huge amount of that, the money that's coming out of ETFs or coming out of some of the investment side of things can be soaked up by the jewellery market and by some of these physical demand from India and from China.
We are seeing that physical demand coming in and creating somewhat of a floor or some support for the gold price.
We advocate those strategic holdings of gold in a portfolio context. We think that it can reduce volatility in the overall portfolio, particularly as people skew more towards equities. Clearly, we think that having those stabilizers within a portfolio is still very, very healthy.
Welcome to another one-to-one mining investment APAC online content session. Today, to touch on the gold outlook, we have Sunil Kashyap, Managing Director, Head of Asia Commodities at Scotiabank. We have Jim Copland, Executive Director for Small Caps at IFM Investors, and Wayne Gordon, Executive Director and CIO at UBS. So thanks everyone for joining us today.
Thanks,
So I guess to kick off, gold prices has had a pretty big move the past couple of days, and so what's happened with the gold price? It was record highs last year. What's happened over the past couple of days? Where do you see things heading moving forward? Maybe Jim, do you want to kick us off here?
Sure, thanks, Amy. Gold has had a bit of a bounce here. I think, though, gold prices for 2021 will probably trade lower than they did in 2020. We forecast a range of probably between $1,700 to $2,000 US, so lower than last year. On the positive side, if that's correct, then we are at the lower end of that range rather than the higher end. But I think what it's all about, and I'm interested in what my friends have got to say about this too, is it's all about real rates. As we're seeing that 10-year go up, real rates are going up. That's putting pressure on the gold price, and that seems to be what the key driver is today. I guess the reason I'm a little bit sanguine about the outlook for gold in that environment is that traditionally low to negative real interest rates are good for gold. Now, even if rates go up another 50 basis points or so from here, we're still at about zero in terms of real rates. So that continues to be a good environment for gold, in my view. And the opportunity cost of holding gold at zero real rates is still very low. So from an historical perspective, that's, I think, supportive for gold investment. But I certainly acknowledge directionally that the more rates go up, the more pressure that there is on the gold price.
Yeah, maybe I come in here. I pretty much agree with that sort of outlook. We have a year-end target of around the 1650 at UBS, and we've had to lower that since the adjustments on nominal rates have sort of come through. I would argue that from a real rates perspective, probably the upside for real rates here is probably, we sort of moved from around the -1 at the beginning of the year, if you look at the 10-year tips as a proxy, and we're now sort of around the -0.5s. My suspicion is that there's probably a little bit more upside from that context. And so I guess we have seen a fairly big adjustment. We've also seen very big outflows from the ETF side of the market. So investors clearly are responding to that sort of directional change in real interest rates. I think one of the key issues, though, we faced this year is the market more generally had a consensus of a much weaker US dollar over the course of this year. And now with the stimulus package coming through, probably higher than what most people had anticipated when we came into January. Most people at that stage were talking around about $1 trillion, I suppose. They thought that there'd be a little bit more negotiation between the Democrats and the Republicans on this. It seems as though the Democrats have been very willing to push quite hard on this particular stimulus package. And so the consequence has been that we've seen this sort of step change in at least 10-year yields, not so much at the front end, but in 10-year yields. The Fed still does sound very dovish, but you would have to argue that GDP numbers are going to continue to be revised higher in the US. We're probably likely to see an element of US outperformance relative to places like Europe as we go into the second half of the year. And that as a consequence is probably going to keep this US dollar on a stronger bias, I suspect, than what most people had expected. The correlation between gold and the US dollar has been very strong. And so this sort of combination, and I think we've talked about this, Amy, on previous occasions, this combination of a direction of higher real rates, albeit still being negative, the direction of higher real rates, and the dollar is not a great cocktail for gold over the rest of the year. But then going back to the earlier comments, I also agree that ETF outflows probably likely continue to some degree, but at the same time, clearly we had a very weak market on the physical demand side last year. Jewelry demand was particularly weak. So at lower price points, you would start to obviously see a bit of support from the jewelry side of the market as well. So we certainly think gold continues to drift lower, but we think the landing pad will be higher than what we saw in the last downturn for gold, which started around 2011, continued on through 2013. We ended up at around $1,090 an ounce, if I remember right. We think that landing pad's probably higher, and our downside risk case would probably be around the 1,500 for gold. Yeah, so that's sort of where we sit currently. Yeah.
I mean, I think just to take up on the point of ETF versus physical, I think it's an interesting discussion because all of last year we saw the ETF holdings as well as the depository holdings on the CME, the Chicago Mercantile Exchange, going up to record levels. And we saw a real increase in the physical stocks being held for the ETFs as well as the CME vaults, as people and mostly the investment community built up positions in either futures or in ETFs. But on the other side, in Asia, we saw an absolute standstill in terms of physical demand. Obviously, in most of the places, China, India, and Thailand, etc., the shops were closed and because of COVID, and people weren't buying. And so what we saw over the second half of last year, I think, was a net movement of physical metal from Asia to the West. I would say it was probably in the range of about 500 tons that went from Asia across to either Europe or to the US. And what we're seeing is an unraveling. So as you mentioned, at the same time that ETFs started, the futures have started going into a discount against spot, the ETFs have started seeing some selling. What we're seeing here is an increase in physical demand kicking in from China, from India. These two markets were at a discount to the spot price for almost 6 or 7 months last year, and they've slowly slipped into a positive right now. It's actually the demand is extraordinarily high right now, and some of that metal that I mentioned that went into the ETFs, that went into the futures, is actually now coming back to Asia to meet that demand. So just like Wayne mentioned, I think we are seeing that physical demand coming in and creating somewhat of a floor or some support for the gold price. And I suspect if the fact that the Asian currencies, local currencies, Thai baht, Indian rupee, CNY, remain at these levels, that means that the local currency prices of gold for the buyers in these markets remain quite attractive, and so demand will be strong. And if gold slips down a bit, I think demand will be even stronger.
I guess just to follow up on that, do any of our other panelists have any thoughts on kind of the physical markets and if there's any lasting impact from the shutdowns and stuff that we saw last year, and Do you have a similarly positive outlook on that?
I mean, I think my colleagues are more knowledgeable about physical markets, particularly in Asia, than I am. But what I did observe is certainly in India, it was a good, as Sunil mentioned, the physical demand toward the end of last year, really came back. It was a good wedding season, I understand, and Diwali. Also, Chinese New Year saw some strong retail demand. So, I think, to the extent that part of the pressure on the outlook for gold is a return to trade, return to a normal world, that means that physical gold flows will absolutely be able to continue to happen. And one of the beautiful things about the gold market is when the price falls, we do see that particularly the jewellery side of things really step up. Last year, jewellery demand was awful. It was, I think, 1,400 tonnes, whereas normally it's more like 2,000 tonnes. So there's a huge amount of that. The money that's coming out of ETFs or coming out of some of the investment side of things can be soaked up by the jewellery market and by some of these physical demand from India and from China. And I guess the other one I might mention might be central banks. Again, last year was a pretty low year for central bank net buying. We saw Russia and China step back a little bit. And the previous couple of years, they've been very strong buyers of over 600 tonnes per annum. So I wouldn't be surprised. I think, in fact, more recently, we have seen Russia maybe come back a little bit, particularly with oil prices going back up again. And China, likewise, that they certainly have a very low level of relative holdings in gold in their foreign reserve. So I see, again, I don't disagree with the outflows coming from ETFs and from the investment side, particularly if that US dollar does strengthen. But there are some natural, I think, aspects of the gold market which can support pricing at lower levels. And I think we're actually already seeing evidence of that kicking in.
Yeah, just on the central banks, I think you're right that some of the traditional buyers like China and Russia were quieter. But on the other hand, we've seen some of the other central banks, and I wouldn't mention names, but in the Middle East and some of the smaller countries in Asia have actually been accumulating gold because the opportunity cost has been close to zero, and in fact, rather than investing in bonds, euro bonds, for example, yielding a negative return, they found that it's easier to just buy gold, and that sort of played into the general investment sentiment also. So I think net, the central bank demand was sort of neutral last year, even though some of the big names which everyone got used to were not buying as much.
And I guess looking at other investment trends, there was a lot of talk last year about kind of generalists getting involved in the gold markets. Do you see this still happening, or was that just kind of a blip that happened due to COVID and other circumstances?
Yeah, I would argue actually that we have seen a sort of I suppose a more structural shift, particularly from some of the asset managers who traditionally haven't included gold in their strategic allocations. That certainly has been a trend that was very obvious last year. I guess the key for me is, do you see not so much an outflow from that particular strategy, but do you see a rush to continue to add gold into strategic allocations? And I think that's where we're going to be very dependent on where people see inflation, for example, recovering to. Clearly, in the past, when we take notice of history, during periods when we've had particularly strong inflationary trends, such as in the mid-70s, also in the mid-80s, and again, we saw very strong inflationary trends in the mid-2000s. What we did get was a lot of efforts to secure gold from a hedging perspective. Now, we know that when inflation is more sort of, I suppose, reflation, in the sense of some return to normal, gold doesn't particularly perform well in that environment. But when we see inflation begin to pick up towards the sort of 3% or so on a more sustainable basis, when you have these things occurring, I guess gold could be seen as that sort of inflation hedge as we go forward, and I guess in that sort of context, one would expect that asset managers could continue to hold those positions. They may not add significantly in this environment, but they will continue to be far more sticky in their holdings than what they've been in the past.
Yeah, I think I'd like to add also, just in terms of what we're seeing, what we hear in Asia is that, the interesting dynamic that's taking place is with high net individuals, especially family offices, which are coming up. There is now much more awareness of gold as an asset, as a asset class, aside from just holding physical gold. And generally it was assumed that you buy gold for physical purposes. So, but the whole story of possible inflation, the rise in government debt, the supposed fall of fiat currencies, etc., I think has raised the awareness amongst some of the high net worth individuals, family offices, and there's certainly much more discussion about, how much gold should I hold, in what form, what are the options available, what are the costs. So that is an interesting metric that's come in.
And I guess looking at M&A activities, there's been a few good years of kind of strong M&A in this industry. Do you see that trend continuing? What do you see happening on that end?
I might jump in. Look, I think one of the things that a fall in the gold price is good for is it helps M&A. It does get the producers' expectations maybe a little bit more realistic when the prices fall, because things aren't quite as rosy, and also capital markets are probably a bit less available when suddenly the projects are more marginal than they used to be. So I do think that helps. But one thing I would point out is that even at current gold prices, and particularly here in Australia, they're still operating with very good margins, 30 to 40% EBITDA margins, maybe more at some of the better projects. And so it's not quite a stressful enough situation, I don't think, for there to be a real resurgence of M&A activity. And the other thing, I guess, is that the nature of M&A down here, at least, has been a little bit different from the past. We've seen Saracen and Northern Star merge with a zero premium merger. Now, I'd argue that was positive for both shareholders at the end of the day, because they instead of that differential up front and the acquirer suffering a hit and the acquiree suffering a bump in the share price in the short term, the zero premium merger concept is positive for both, because you don't get that sort of disruptive effect up front, provided that the fundamentals really support that merger. In Northern Star and Saracen's case, there was an asset that they co-owned, the super pit. So it made a lot of sense. A previous one was Silver Lake and Doré, and likewise, it made a lot of sense for those two to get together. And I think that the performance of the share price afterwards really helped. But I'm actually at a conference at the moment, and there isn't sufficient misery around at the moment for people to feel too desperate about merging. But there are discussions going on, and things are probably a bit harder than they used to be 6 months ago.
I don't know if any of our other panelists want to touch on that at all.
Yeah, I tend to agree, actually. I think when I look at the gold mining stocks, they've sold off, a number of them have sold off very, very sharply, even relative to the move in the underlying. Now, we know that gold equities, they trade at a higher volatility to the underlying. They tend to track the underlying quite a bit. Clearly, they're going to deliver a lot of cash under the current, even at the current spot prices, as mentioned by Jim. And so when I look across the miners more generally, I guess from my perspective, I'm favouring those sort of producers who perhaps they do some gold, but they also do some of the other metals as well, largely because they get a little bit of leverage from that side as well. Also, some of the gold miners have made significant inroads from an ESG perspective, and some of the names that we look at haven't really gained a premium from some of the work that they've done in that context. The nexus of it is that I agree with Jim that these gold mining stocks, they've come under a lot of pressure. They're generating a lot of cash. I don't think some of the stocks have achieved the premiums that perhaps that should accumulate to them for a lot of the work they've done around the ESG element. And so relative to the rest of the miners, they're looking good value at this point relative to some of the other producers who these guys have taken, the gold miners have taken a big discount to.
And so you bring up ESG, which I mean, it wouldn't be a mining investment panel if we didn't talk a bit about ESG. And so I guess, you know, what are you seeing on this front with kind of the stronger standards and criteria around ESG investing for, you know, for both for the miners as well as for investors in this space? So, you know, how is it impacting investment? What sort of, you know, what are the impacts that you're seeing from these stronger standards?
Maybe I'll start first. I just, you know, to talk a bit from the point of view of the actual gold market. You know, ESG is one of the most important subjects right now, because in the industry there's a conscientious sort of move to try and eliminate some of the negative connotations associated with gold and gold refining. And so what you are seeing is a concerted move. In fact, the London Bullion Markets Association, the LBMA, has reached out to 12 jurisdictions around the world from where gold is either produced or it's refined. And what they're trying to look at is, you know, see whether we can create one global standard to ensure that you have proper standards of refining, of ensuring the responsible sourcing, and also the manufacturing processes used are ESG friendly. So that's certainly something which is top of mind for the industry.
Yeah, you know,
you go on, Jim. No, you go.
I was just going to say, again, at a mining conference, and ESG is certainly one of the topics. I think for the copper and nickel miners, they do have a natural pivot because suddenly they're battery metals, and they can tick that box in terms of, you know, the ESG credentials. Gold miners don't have that, but one of the things gold miners do have, as do the other miners, is increasingly an ability to use things like solar, renewable energies in their power costs, because that's become more economic and much more efficient than it used to be, and they're all pursuing that. But one of the things which the gold miners do really well, I think, all around the world, is particularly when they go into emerging economies, is the social aspects of looking after the communities in which they operate. I'm not saying they've always done this well, but it is one of those aspects of ESG which I don't know that they get full credit for. You know, they often, in African countries or South American countries, they ultimately have to do some of the things that the government isn't doing, and that's health and education and looking after those local communities. And so, you know, when we look forward at ESG issues, it's becoming increasingly, you know, important for mining companies. And gold, when it doesn't have a battery metal thematic to it, I do think it needs to draw upon some of those other benefits that it brings to global communities when they talk about their stories, and of course continue to do those things. And but yeah, it's interesting because it's at every single one of the presentations now. It's front and center. Yeah,
I can only concur that the comments there. Increasingly, I'm impressed with the way in which a number of these particularly the large caps and also the medium cap companies have really embraced trying to do better and trying to, I guess, communicate the inroads they're making, particularly not on governance, but also on the environmental side. The one key thing we've noticed is UBS is a pickup in the demand for what we call green gold or sustainable gold, where clients will actually purchase bars that have those standards that have been talked about earlier applied to them. And the demand for those bars continues to rise. Now, there is a premium for these gold bars that you can purchase, but clients are doing this increasingly. But not only that, but also when I talk to a number of the companies, they also are trying to step up their advocation of being able to certify the end product so that investors can take a part of this. So these are two things which have been sort of accelerated, interestingly enough, since the COVID-19 outbreak, where people have started to really focus on these environmental standards, the governance standards, as well as the social aspect that Jim talked about. So from my perspective, this can only increasingly form part of the discussions we have, not just on the mining equity side, but also on the clients that we talk to that are actually holding physical gold.
Absolutely. And so I guess just to wrap it up, what are your thoughts on the next 12 months? Where do you think we'll be going with the gold price, with investment trends? You know, what are your broad-based predictions for the gold industry this year? Maybe
well,
Jim.
let me start from just the physical demand. I think Jim mentioned at the outset the fact that last year demand was constrained. So I think some of that demand in terms of jewelry demand has gone and will not come back. But we are seeing now that some of that demand was pent up. And in terms of, for example, in India, the weddings were postponed. And so that's all starting now. And so that's creating a real kick in terms of demand. And I think as people start going out and the shops start opening, a lot of the disposable income, which was held back with them, will start now getting spent, and people will start buying gold once again as far as the Asian countries are concerned. So that's going to be positive for physical demand for this year.
Maybe I can go. I'll leave you to go. I'll leave you to have the last word, Jim. How does that sound? I think that's a good thing. So from our perspective, yes, we do have a relatively negative view on gold, at least over the next 12 months to some degree. We do think that prices, albeit they probably lift a little bit in the short term, but we do think prices can move lower over a 6 to 12 month view. Having said that, and that's largely based around, I do think nominal yields will continue to edge higher from here. That's going to keep pressure, or at least upward pressure on real yields. But the thing I think that could surprise the market, and particularly surprise it to the better for gold, is if inflation continues to surprise the market to the upside, particularly in the fourth quarter and into 2022, because of course we all know that the base effects on inflation are going to be phenomenal in quarter 2 and into quarter 3. But as we go into quarter 4 and quarter 1 next year, if that lift in inflation is persistent, then this whole notion of holding gold from an inflationary hedge perspective can return, and then that could actually begin to slow the outflows we can see from the investor side, particularly on ETFs.
Last words from Jim.
Yeah, no, look, Wayne, I think absolutely it's all about it. I think it's all about inflation. I'm a geologist, not an economist. So people much more knowledgeable about this than me are saying that inflation may be coming. And I think that is partly, the reason I'm probably more on the optimistic side. That said, I think for our perspective, we've got an equities portfolio. We've 5% of the index in our world is in gold stocks, and we're about index weight. So we're not aggressively overweight on gold, but at the same time, I think it's dangerous not to be there for that very same reason. So yeah, I tend to err on the side of more optimistic about gold than some, but I can see the risks of not being there. Just taking into account all of the uncertainty about the inflation outlook, and also this recovery that the world is currently undergoing. There's plenty of uncertainty there, and I think that is ultimately good for gold.
Yeah, just probably lastly for me on that, Amy, I just want to reinforce something that Jim has just said there. I think from our perspective, when we're talking to our clients, we particularly when we're talking to those clients who hold strategic allocations to gold, from our perspective, we advocate those strategic holdings of gold in a portfolio context. We think that it can reduce volatility in the overall portfolio, particularly as people skew more towards equities. Clearly, we think that having those stabilizers within a portfolio is still very, very healthy. So from our recommendations to clients, it is to hold that strategic allocation and maybe look at some options to protect the downside to that over the next 12 to 18 months. But certainly, as similar to Jim, we think that sort of strategic allocation is still extremely relevant from a diversification perspective in that portfolio context.
Absolutely. Well, that just about wraps us up for today. I want to thank all of our panelists for taking part, and we hope to see everyone again at an in-person event soon. So thank you.